Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for July 2nd, 2023. We'll start the chart back this week with the Economic Surprise Index, and I have to admit here that we have seen some data on the economic front that has been better than expected, and certainly better than we would have ever guessed entering the year. And you see here the Economic Surprise Index has taken a little tick up here as of late, and this data series goes back a little bit more than a year, and you can see, the gyrations in this, but we have seen, honestly, looking at February through June, a lot of this has some labor connotations to it. A lot of this has some consumer spending connotations to it, but the data by and large has not been that bad. And here we have a compilation of several Federal Reserve Bank regional surveys, and you can see here from a price standpoint that both prices paid and received continue to come down from their interim peak levels that we saw roughly about a year ago. And so this is your purest business indicator that inflation is moving lower. And here we have non-defense capital goods orders and shipments. You see in this line here, both the orders in red and shipments in blue, that we have recovered more than fully from the pandemic. We do see a little bit of a stall factor happening here in May. Of course, this data series goes back to 1995, so you can see the cyclical turns. And so, when you look at prior recessionary periods and how we entered those, you could see a little bit of momentum at the top, both in 2000, 2007, and the pandemic was a bit of an anomaly. There are a couple of occasions here over the last decade where we did witness kind of a false peak and didn't have a recession, but say that there is some put and take out of this. One, the levels in aggregate remain reasonably high. There is a little bit of slowing in that growth, but it's still positive though. Looking here at some data from the St. Louis Fed, we have a rather interesting chart. When you think about the tightness in the labor market, this has something to do with it. Look at the dotted trend line, which are the predicted rise in the percentage of the civilian non-institutional population that is retired. And you can see the pandemic really accelerated retirements. We know for a fact that a lot of people exited the workforce, particularly in the older age cohorts, and a lot of them honestly haven't come back. And you can see how far above trend line we actually are, and in a series here that is very much indicative of an aging population anyway, but we see this acceleration tightening that labor force to where we're still looking at about 1.66 available jobs for every unemployed worker. Here we have a chart. We've got a couple of charts actually on the consumer. We've got household debt service payments as a share of disposable personal income. See in the aggregate relative to history in a series that goes back to 1980 that we are below on a percentage basis where we have been in the past. And we're actually below where we were prior to the pandemic. And you think about, debt service as a share of disposable personal income, even though debt levels are rising, debt service payments are still relatively low. Now, I do see that rising in the coming months because the rates on debt service are moving higher because of the higher interest rate regime, which we now have. And but when you think about, are we at a crisis point? And the answer is no. Here we have private sector debt as a share of GDP. You can see the numbers here, with the rise in overall debt levels. That's something that we obviously want to monitor. We've got households and nonprofits, those levels, as well as non-financial businesses, continue to come down. Now, these are elements of the economic spectrum that are actually positive right now that we can talk about. Here we have households that continue to accelerate excess savings in a lot of parts of the globe, even though excess savings are coming down in the U.S., and we've talked about that for many months now, due to spending habits wanting to be maintained in the absence of government stimulus payments, et cetera. So rather oddly enough, you can see in the dark blue here, U.S. is trending lower, which we just talked about, but a lot of other areas of the globe are moving higher, in areas where you typically tend to see higher savings levels at the consumer level. And I think this paints the picture of a stronger international backdrop overall. And again, it's going to be regional, and country selection, regional selection will matter a lot, but you can see here the divergence between the international spectrum and the U.S. in terms of excess savings. Here we have some interesting observations coming to us from Global Macro Investor. In the white, it represents the U.S. Consumer Price Inflation Index year over year. So you can see the downward trend. The dotted center line at 0 represents the month of peak inflation, and so now we're obviously tracking after that point, and so you can see inflation's coming down. We certainly know that. We do know that there are some elements of inflation that are still relatively sticky, but what's interesting about this analysis is what Global Macro does in overlaying the average of 5 prior outbursts of inflation dating between the 1940s and 1980s, and you can see the uncanny resemblance of these trend lines. And so, if you think that you've got to get down to 2% inflation, you can see here that the average of these 5 prior inflation cycles is that it's going to take you probably a couple of years to get there, and we're not really, but roughly half the way there. And so again, patience is a real virtue, but the power in this chart is just how much the current inflation cycle resembles this average. We've got a couple of charts from Yardeni.com here, and argument that will be made in the 2 slides that I'll show you here is that there is a lot of pent-up economic power in certain generations, whether it's real estate equity or it's business equity. And this one in particular shows you equity in non-corporate businesses by generations. And the 2 key ones here that obviously that we focus a lot on are the baby boomer generation, which we know are getting older, and then the Gen Xers, which are getting older and kind of moving into that pilot seat, if you will. And you can see that there's a tremendous amount of equity that is, I guess, and for lack of a better term, kind of stored here in this particular equity. Now, this is equity that has yet to be monetized, and of course, we're going to have a lot of generational turnover. And the arguments that are made in the research piece, which this chart emanated from, was that there's still a lot of pent-up economic power, spending power, what have you, in this equity ownership that is yet to be realized. As we were just talking, you've got the baby boomer and the Gen Xers that also own a lot of real estate. And so, again, this is wealth that's tied up in illiquid assets that has yet to really be monetized and then put back into the economy. So this obviously fills up statistics on a sheet, but it's not generating that kind of multiplier effect that cash in the bank does. Quick chart on debt limit deal and what it does for government spending. So, in all arguments, you try to look at both sides and try to rationalize, okay, the fact that we do have positive data, what are the potential headwinds here as we look ahead? And this is one of them. You've got federal spending. We know that the debt ceiling deal will curb some of that spending for at least a period of time. You can see here projections call for relatively sluggish growth going forward, and of course, government spending is one of the primary components of GDP. Here we have kind of a compilation of some of the various stimulus programs. And of course, we've been talking a lot about the fact that stimulus has by and large gone away. And you can see that kind of graphically depicted here, that a lot of those programs that were pandemic era have gone away. And we actually do see the some latent benefit from, say, things like the CHIPS Act. But the magnitude of the impact of these things is still relatively small compared with what we saw during the pandemic, which was historic and not only in aggregate but also percentage terms. There are some offsets to some of these programs, i.e. the Fiscal Responsibility Act. So you can see here that the net impact on a relative basis from these fiscal programs is going to put a lid on government spending for a while. Here we have the fiscal impulse that also includes state and local, and that's in the green. So, the positive takeaway from this is even though federal spending at the government level is going to be sluggish, likely for the foreseeable future, state and local governments do have increased spending power because of tax receipts, property values, so on and so forth. And you see that depicted in the green. So it's a slight offset, if you will, to federal spending. Again, it doesn't move the needle that much, but it is worth noting here. Here we have, going to say, is the best representation of what would define recessions. Now, the National Bureau of Economic Research, the NBER, actually dates recessions. And the common wisdom is that recessions were defined by 2 consecutive quarters of negative GDP or negative economic growth, and we had that last year. But there are other things that did not fit the definition. Employment was still strong, and incomes were still strong, and those are things that you generally don't associate with recessions, or at least, the strengthening levels of each of those 2 categories. And you can see, there's several things that go into the definition of a recession, and it is, oftentimes defined as a significant, consistent weakness in several aspects, critical aspects of the economy. You can see, various data series overlaid here, and then also overlaid with these gray bars, which represent recession. You see, you've got gross domestic income, you've got aggregate weekly hours of production, you've got retail and service sales, and you've got a lot of different details here. And you can see where we are right now in the spectrum, and this series goes back into the 1960s, but you can see the oscillation here that we are headed down, right? And so this is what we've been watching kind of in the backdrop of other data, like say 14 consecutive months of declining index of leading economic indicators, which has very strong predictive power. And we can see here that a lot of these categories are trending lower. Some are already negative in the sense, and you can see the predictive power of having multiple data series within this chart go negative is very predictive in terms of like a pending recession. And so, again, as I've talked about last week and the weeks prior, some of this data has been better than expected. But one thing is clear, that the Fed policy initiatives, interest rate increase, policy tightening tends to work at a fairly significant lag. And so it's quite possible that we have yet to see the full impact of these rate increases on various parts of the economy. And when you look at a chart like this, you do have to take stock in it. You can't be complacent and just say everything's going to be great, soft landing, no recession, blah, 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 because the data is compelling in this case, and we have to monitor it. Now we're going to talk about the stock market here. We've got 12-month trailing PE over a 10-year basis. You can see where we are now. We're about 22.5 times, and you can see the trailing 12-month PE 5-year average there is just, we're kind of basically at that right now. And then we're above the trailing 10-year PE, which is about 20.5. So again, we've established a kind of a relatively new baseline for PE over the last decade. And so this would argue that, the market's not incredibly overvalued, but it is not cheap by any definition. Here we have a chart from Fidelity. Again, a little bit busy here, but this looks at the next 12 months PE, and we're about 19 times. In fact, this is slightly dated. We're actually a little bit closer to 20 times now. So again, the market's not cheap. You look at where we were relative to 2016 to 2018, when we had data that was on balance looking positive. Now, as you just saw a couple of charts ago, that we have kind of a general preponderance of data that looks somewhat weak but positive, but the trend lines are not that great. And so when you look at this, and you've got about 19, 20 times earnings with data that looks like it does, do you get really excited about investing headlong into the equity market? And I'd say probably not. Here we have some more internals of the market, and you can see from this chart, which represents the percentage of members of the index, and this is defined by the constituent members within the S&P 500. And again, you assume the S&P very roughly has 500 stocks in it. That right now there's only 4% of those, despite a rising market, that are experiencing new 52-week highs. So this is really another piece of confirmation that the market rise this year has been very narrow. The breadth has not been very strong. I mean, you have a concentration of growth within a very, very small handful of stocks, and we've talked about that fairly consistently. And these are the technology stocks that have this AI, artificial intelligence moniker tied to them. So more to the point of lack of breadth in this market this year. And so I found this tweet from Michael Kramer out there, which I thought was great. I went ahead and pasted the full text of this because the data is important here. So essentially, the rise in the market, again, to my point earlier on that last slide about the being driven by a fairly narrow set of stocks, we've got the top 3 by themselves have accounted for 47% of the move in the market. And of course, the top 10 account for the lion's share of it. And again, just to remind you that the S&P 500 is a cap-weighted index. So the large companies have a significant influence here. And when you look back in 2019, when we had another relatively strong market in the first half, that breadth was much more broadly based. Here we have a very, very busy chart of asset class returns since 2011, and you can see how a diversified portfolio serves you best over a long period of time, because if you make a particular bet on a certain asset class or even a sector within an asset class, that you might very well miss the boat. But over time, where we're focusing now, obviously, is in large cap, strong companies, dividend growers. You can see that those have performed quite well. Bitcoin, maybe not too surprisingly, has performed extremely well. There's obviously lots of ways to kind of play that, but you can see, after the top tier performers, you get into convertible bonds and international stocks, which we're rotating a little bit more into, that have performed quite well over the last 12 years or so here. And then you get down to small caps and et cetera, and returns are a little bit more mixed. Here we have the number of S&P 500 companies with negative guidance. And so just as we were talking about valuations before, we can see here in this chart, even though it's not abundantly clear, but it's in the data that's tied to the research that this was published in, that 59% of the companies in the S&P 500 that have issued guidance have issued negative pre-announcements. And again, so when we go back to valuation, we said, well, the trailing 12-month is about 22, 23 times earnings. The forward priced earnings is about 20 times earnings. And you have the majority of your S&P 500 index constituents that are negatively pre-announcing earnings. Does that get you excited about jumping headlong into earnings for the time being? And again, my answer is no. Long term, yes. Short term, perhaps not as much. Here we have the earnings growth by sector. Again, you look kind of towards the fourth from the right here represents the S&P 500 itself. As I mentioned in the prior slide, we have expected earnings growth for the second quarter of about -7%. That is a slight deceleration from what we saw in March, and you can see energy and materials and healthcare are all contributors into that negative growth, whereas consumer discretionary, oddly enough, again, the strength of the consumer, putting money on credit cards, increasing their debt overall, kind of gradually over time, is one of the offset levers to that weaker earnings growth in these other sectors. So obviously, this is a composite of these different industry sectors, but certainly not an absolute, and we'll get more confirmation here in the coming weeks when companies begin to report those earnings starting in about another 10 days or so. Got a chart here on home prices. Interesting work by Liz Ann Saunders at Charles Schwab. Looking back over several decades where we saw pressures on home prices, and not too surprisingly, the biggest drop we found was during the global financial crisis, which in many respects was driven by froth in the housing market. So we have obviously seen a dip in this particular index, the Case-Shiller price index of about 1.8%. It does pale in comparison to the global financial crisis, and you can see how it compares to the early 1990s, where we also had price deceleration. But where we stand now, again, just for the purposes of looking at it relatively speaking, is not that great. Here we have the spread on the 30-year fixed mortgage rate and the 30-year treasury. So mathematically, you just take the mortgage rate on the fixed 30-year mortgage and subtract the 30-year treasury rate. Now we know the yield curve is inverted, but there's a pretty stout relationship here, and you can see it does kind of oscillate around the average of about 1.4 percentage points, and right now we're about 2.8. So we are literally double the average. And again, you go back in 2000, there was a recession there. You go back to 2008, 2009, there was a recession there, and these were the most recent, and of course the pandemic. Those were the most recent periods where this ratio was above 2 percentage points. And so obviously we're almost 3 right now, and you've got to go back really to the 1980s before you find a kind of a gap in that particular statistic like we've seen right now. Here we have some office vacancies and across the country. Left-hand side, you see some of the lowest vacancy levels. You can see Boston, Miami, Charlotte, Philadelphia, and Los Angeles, and then some of the highest, oddly enough, Austin and Houston really top that chart. I know there's a lot of sublease space available here in Austin by virtue of some of the large publicly traded technology firms that are trying to improve their income statement if we are heading into an economic slowdown. But you can also see San Francisco, which we've talked about a lot. Now, again, this is office, so we know that San Francisco has a lot of vacancies, and then Seattle and Denver are on that list as well. Here we have a chart showing tightening lending standards for non-residential commercial real estate. We do know that lending standards across the banking spectrum are getting tighter, and this particular chart shows us those standards specifically for commercial real estate loans, non-residential. Here we have treasury yields. We're looking at a chart of the 2-year yield in the kind of the lighter color, and then we've got the 10-year in the darker color here. And we do see that during the month of June that rates at the 10-year level were pretty flat, and we saw increased steepening, I think reflective in some measure to this thought that the Fed is going to continue to raise rates. And I think this this pivot, if you will, is kind of off the table for the time being. The feeling is the Fed's going to raise rates perhaps by another 0.5 percentage point by the end of the year. Maybe we get towards the latter part of this month, July, when the Fed meets, it will get a 1/4 point raise, and then perhaps we get another one in September, October-ish. But rates are definitely higher. Bond market does generally a better job of kind of foreshadowing economic slowdowns. And the fact that the 10-year has been very, very sticky amidst some of this, improved rhetoric about the market health and so on and so forth, the economic data maybe coming in not as bad as some people had expected, it still hasn't translated into higher long-term yields. And so I think this is very, very important. The yield curve inversion has increased over the last 60 days. You can see that very clearly here. And I think with expectations fairly anchored at the longer term basis, obviously the bond market here is kind of foreshadowing some weakness coming forward. And something else that we're watching here as a kind of a measure of the health of the economy, or a barometer which kind of gives us some insight into what the bond market's thinking, is the junk bond spreads. And so these are represents the difference between the bonds of companies that have lower credit ratings and the risk-free rate, which is the U.S. Treasury. And you can see these spreads, if anything, over the last couple of months have come down, and this is a sign of complacency. This is a sign that the market believes that perhaps that credit is not going to erode in the coming months, and it's less a sign, as it was in the past, of people stretching for yield, because obviously we know that you can get a 3-month Treasury for around 5% now. So this is really more reflective of the fact that market feels like, maybe credit is not going to be as bad. We're not going to have as many defaults, et cetera, as people would have thought. Our last slide of the day, drawing from an article in The Economist that was cited in some other research I was reading, really brings home this notion of the lack of bipartisanship in our political sphere today. And I just got through reading a book by Ezra Klein called Why We Are So Polarized, which really offered a lot of insight, particularly in the first few chapters, about how, oddly enough, that you have, liberals and conservatives that didn't necessarily identify as, liberals that didn't necessarily completely identify as Democrats, and then conservatives that didn't necessarily, identify as Republicans. And you can see that even as recently as 1980, back when Reagan was elected, and there's a lot that's been made over how he worked with Tip O'Neill in Congress, and they were able to move bipartisan legislation. And I thought this This particular chart does a really good job of showing the polarization that has evolved over the ensuing decades. And back in 1980, you obviously see here my point that you have this overlap of blue Democrats that kind of occupy this maybe more conservative space and vice versa from Republicans. But that has largely gone away now, and where we are in 2018, which I guess is the latest data point here in this particular survey, is just how isolated these two sides are right now, and it makes it difficult to get legislation across. And I think a lot's been made about how this impacts the future growth of our nation, future growth of our economy, et cetera. In fact, I just got through reading an article about the outgoing executive director of the Council on Foreign Relations, Richard Haas, talking about how he views this polarization as being one of the major risks to overall global health in the coming decades. Well, that will do it this week for Charts and Chat. Hope you've enjoyed the package. Have a great start to your week. Enjoy your 4th of July holiday, and we look forward to talking to you again soon. Take care. Bye.